All right. Welcome back to another market recap and a look ahead. I hope you guys are having a great weekend. And for any new visitors to my channel, welcome. And thank you for spending a bit of time with me. And please don't forget to hit the subscribe button and the bell so you can be notified. Okay, so I'm just going to get into it. And pretty much you can see on Friday, actually in the week, we just had more record highs and more record highs. I mean, is anyone really surprised? You're going to keep getting more record highs in terms of your Russell, the Dow, the S&P, and your NASDAQ. And you're going to keep getting that. And the reason for that is simply because until the Fed itself says that they're going to be tapering or stop buying everything, this market is going to just keep going up higher and higher and higher. It is really the Fed market at the end of the day, and they're the ones dictating everything. But on the back of that, you can see that gold itself took a horrible beating, and I'm just buying more of the dips. At the end of the day, it's just presenting fantastic buying opportunities here for me. Okay, so you're going to be reading a newspaper and the medias, if you haven't already. They've been saying that, you know, the economy, well, the market's finished off strong simply because of the job market reports. It was better than expected. Well, I want to challenge that notion, and let's just quickly have a look at the jobs reports. Okay, so the US adds 943,000 jobs, and the employment sinks to 5.4%. I mean, just off the back of that, yeah, fantastic. This is why, you know, the market's rallied. No, that's not why. And I just want to break this down quickly, and I'll show you why this is not why it actually rallied. If you have a look here, the majority of the employment actually came from the leisure and hospitality side, but also from governments. Now, I want to show you something else. If we go here, right, this is the ADP, the National Employment Report. Now, this report actually ignores the public sector and only focuses on the private sector. And I'm going to show you how terrible the employment rate is for the private sector in the US. And you can see that the information sector actually retracted, lost 1,000 jobs. And if you carry on down, this is really what I wanted to show you. So this is the actual true economy from the private sector side of things. It is going down. There isn't new jobs being added, so this can go up. All right, so the economy is retracting, and that is not why the S&P 500s and the Dow Jones and the NASDAQs or any of that actually went up. And the reason why it went up is because the markets know that the Fed is still going to be putting in money to prop up the market. They are nowhere close to tapering. You got to understand the US economy right now is a heroin addict, and it is addicted to the Fed's feeding it heroin, well, feeding it, the US dollar into propping up this economy. So don't buy into this narrative. There is going to be no tapering whatsoever. The Feds are just going to keep pumping and pumping and pumping more money into the economy. And if we have a look at the Dixie, absolutely, there's still room for it to grow, but there is a resistance. But not that much room to grow, to be honest with you. And then from there, I do actually expect the Dixie to be completely smacked down. So this is also why gold went down. Well, commodities ultimately went down is because there was such a strong surge in the Dixie. Remember, they correlate opposite from each other. So as soon as you get a strengthening Dixie, you're going to get a weaker gold pricing or commodities pricing. Now, typically, the markets also don't like a strong US dollar. So why was the S&P 500, the Dow Jones, ending off Friday on a high? Well, that's because it was cushioned and propped up by, you guessed it, the infrastructure bill. So I want to get into that now. Right, so this is the bill, and it shows you everything. And this is fantastic for you to start positioning yourself, because as you can see, you got $73 billion going into electric grid and power infrastructure. That's solar, that's your green energies, that's going to be nuclear power plants. So you got to start positioning yourself there. You got $60 billion for passenger freight rail, so get into freight rail. You got $65 billion for broadband investments, so there's going to be heavy stuff going into 5G in terms of that infrastructure. Now, I'm actually busy doing a video called Megatrends of the Future, and I'm going to be touching base on that. I'm actually breaking it down into 5 series, and one of them is going to be touching a little bit on the infrastructure for space and how broadband and 5G actually plays quite a critical role to all of that. But if you have a look also, you got 55 billion of water systems and infrastructure. So again, start looking at utilities. Then 70 billion for ports and waterways. This is actually quite a big problem right now, sits globally in terms of ports. There's such a congestion happening, particularly in the US as well. So fantastic places to start maneuvering yourself. Then again, the electric vehicles. So the likes of Tesla is going to do very well with things like this. 11 billion for road safety. So this makes up the entire infrastructure bill. And commodities is going to do really well with this, like copper and iron. They're going to do extremely well with this type of play. But it's not only that, it's your steel manufacturers are going to be fantastic in terms of your investment player. Now, this bill is just about ready to pass, okay? And this is why you saw the likes of the S&P 500, the Dow Jones going up, was simply because of the infrastructure bill is just about at its completion. It's not because of the jobs report. I just showed you from a public sector point of view, the jobs report is terrible. However, there's another side to this infrastructure bill that also caused a massive rally in terms of Ethereum and particularly Bitcoin. The other side of this entire infrastructure bill is somehow cryptocurrency got into this. And it's actually quite good. And I'll explain my reasoning in a minute. Now, what is cryptocurrency doing in the infrastructure bill? Well, the answer is quite simple. If we scroll down here, we've got initial lawmakers propose a provision that would impose stricter rules on how digital assets are taxed to help fund the 1 trillion bipartisan infrastructure bill. So in other words, the government is looking at the crypto space and it's like, okay, we can get some money out from the crypto space to help fund for this infrastructure bill. And the best way they can do that is, well, let's just tax everybody. Okay, so one of the biggest contentions, as you can see, there was a backlash from the crypto space itself and pretty much over the clarification definition of broker. So on the one hand, which is backed by the White House, is declaring everybody in the crypto space is now a broker. All right. Your miners are brokers. Your validators are brokers. Your developers are brokers. Everybody's a broker, and therefore you are subject to sales tax and other taxes and blah, blah, blah. So we could just distract money to fund our 1 trillion bipartisan infrastructure plan, and everybody's happy. Well, no, that you can't just go and try and steamroll this in. Now, what has been surprising and what has been so fantastic to see is that there are actually crypto champions in Congress, and these are people on our side. So if we go down, and it's these three people here. So it's Waden, Toomey, and Loomis. I'll apologize if I pronounce their names a little bit stranger, but they actually proposed an alternative. They are sticking to the stricter definition of a broker, and that stricter definition of a broker is actually on the exchanges in terms of giving information of who they're dealing with, and obviously being taxed with who they're dealing with and who's paying taxes from within the brokerage itself. Okay, you cannot expect your miners and node validators to have that third-party information because they don't see who the end users are. So I don't know how they thought that they could be liable in terms of providing that type of information as well as being taxed for selling the services, developments. This made no sense at all. So it was just far too broad, far too strict, and it would have actually just scared the entire crypto community out of the country, and they would have gone to safe havens, safer places like South America. It would have been a disastrous amendment to the bill if that came through. But luckily enough, we've got some champions in Congress that actually do like cryptocurrency and the innovation about it. And this is such a huge monumental step to where we were like 10 years ago, 5 years ago. I mean, we've got people in Congress that is champion cryptocurrencies and the innovation of cryptocurrency at the end of the day. So we've come a long way. However, we still got the enemies, and we got Portman, Werner, and Cinema. Again, I apologize if I pronounced these names incorrectly. And they've kind of redid their initial amendment, and then the way they've said that now is, okay, we'll exclude the proof of work guys, okay, the miners, they won't need to provide third-party information and, and taxing and all of that stuff. So we'll exclude them. But proof of stake is fair game. So again, the crypto community was up in arms again and saying this is worse than useless, right? You can't just choose proof of work over proof of stake and all of this. However, the way it sits in is Bitcoin's looking pretty at the end of the day. Whatever gets chosen, Bitcoin at the end of the day just carries on looking pretty. But I mean, ultimately, I would, and I think everybody would, even Bitcoiners themselves, they would go for this, would actually support the Wid and Tomi and Loomis proposal, because it is a fair proposal. Okay, so that's why you're seeing rallies in terms of Bitcoin and Ethereum, and ultimately why you saw a rally in the infrastructure, a rally in the stock markets themselves, was mainly because the infrastructure bill is literally just about to get passed. The only thing that's holding it up, funny enough, is cryptocurrency, which is bizarre that we're at that level now in terms of whether bills are being passed or not on the back of cryptocurrencies. I mean, it's so mind-blowing how far we've come in terms of this industry. All right, so let's just have a quick look at commodities. And as you can see, gold crumbled. Why did gold crumble? Because of the vengeful dollar. A stronger dollar causes a weaker gold pricing. It's really that simple. And another thing to pay attention to is oil. Okay, there is some tension, a lot of tension currently happening in the Middle East, and you got to remember as well that Iran has just, I think, put in their new president. I don't know what you call him, but they've got like this new president, and he is quite a hardliner. He is very anti-West by the sounds of it, very anti-Israel, just a very fanatical type of person. It's the last person you need in a tinderbox like the bloody Middle East. But there's continuous attacks, and I've just been reading a bit, but it sounds like he's also supporting and using Hezbollah as his proxies in terms of trying to weaken Israel. So just watch out for that, because oil does love war. If this starts to escalate, well, expect oil prices to go up. Right, so next week, all eyes on inflation will be the sizzling topic for the markets in the week ahead. And the reason for that, if you go down, let's check on Monday. So Monday we got a couple of earnings, but again, you got so much. The Fed president is coming out. Another Fed president is coming out. You got Treasury auctions happening. I'll speak to that in a couple of minutes now. You got the Chicago Fed president coming out. We got the federal budget. This is going to be so big on Wednesday. Jobless claims, again, is going to be very big. And then more treasuries. There's about 3 treasury auctions happening. So Thursday, Wednesday, and Tuesday is going to be treasury auctions. So if we just go here, the US Treasury to auction off notes, bonds to keep government from debt ceilings. This is why there's a massive auctioning that is happening to try and raise funds somewhere so the US doesn't hit the debt ceiling and defaults on the debts. It's massive. It's a massive thing right now, because if the US had to reach that debt ceiling, they can't pay back the debts. It will be the first time in the history of that nation, and it will damage their reputation beyond belief. Okay, so just look out for that. Now, how is that going to play out? Well, in order to buy US Treasury bonds, you have to buy it in US dollars. Okay, the US dollar is going to go up. Okay, because there's going to be competition to get US dollars in order to buy US Treasuries. Eventually, the US Treasury itself will go into a bidding war, and that will raise the bonds itself, which will cause the 10-year yields, particularly the 10-year yields, to actually come down. If there's any dips, there will be some dips, but if there are any dips from the stock market point of view, I'm buying it. I'm buying those dips because they are perfect buying opportunities, because in the long term, this market is still going to keep going up and up and up. While everybody's going to be freaking out and talking about tapering, will the Feds talk about tapering? You'll hear some of the Fed presidents coming out that are very pro-tapering, and it's going to affect the markets a little bit. But the Fed themselves will not taper. They are not going to taper. The market is still in a terrible, the economy, sorry, is still in a terrible, terrible shape. There's not a chance in hell that the Fed is going to stop supporting the stock market until the economy at some point looks at catching up. And it's not going to catch up. We are so far gone. This is the Fed market. That's the new reality. All right. This is Chris Trade. Peace.